My investment career now spans more than 7 decades. During that time, I've seen many developments that, on the surface, seem to defy all logic. I've watched markets surge to wildly inflated levels. I've seen participants eagerly pay absurd sums for assets with no discernible underlying value. I've lived through the formation of bubbles and their inevitable bursting. I recall 1968 when I made the decision to dissolve my investment partnership. It wasn't because I was tired. It was because I couldn't find a single investment that made sense to buy. The market had become too speculative, too divorced from reality. My partners thought I was making a mistake. The market continued to climb for another year, and those who stayed in were making money. They likely concluded I'd lost my edge. But then the reality of 1969 and 1970 set in. The market collapsed. Suddenly, holding cash didn't seem so irrational. That period taught me an invaluable lesson. Being early can be indistinguishable from being wrong for a very long time. But if your assessment of the fundamentals is correct, time will ultimately be your vindication. What we are witnessing today, however, is on a different scale. It's not that the market is overvalued. I've seen that before. It's not that people are behaving irrationally. Human nature is a constant. What is different is the sheer duration of this disconnect. It's the extremity of how far prices have detached from reality, and most importantly, the artificial mechanisms that are sustaining this situation. That last point, the sustainability, is what I want to explore today. Understanding why this market has avoided a crash is far more important than guessing when it finally will. Let's begin with some data. Because figures remain objective, even when human sentiment doesn't. There is a financial ratio that people have kindly attached my name to, though its concept is not mine alone. It is called the Buffett indicator, and its logic is simple. It takes the total market capitalization of all domestic stocks and divides that figure by the nation's GDP, its total economic output. The underlying premise is that stock values, in the long run, should mirror the productive capacity of the economy. If the market value vastly exceeds what the economy actually produces, you are paying too much for future profits. Historically, a ratio above 100% has served as a significant warning. It signals that the market is expensive relative to the real economy. Back in 2000, just before the dot-com bubble imploded, and I remember it vividly, the indicator reached a peak of 115%. The prevailing wisdom was that the internet had rendered the old rules obsolete. Companies with zero earnings were valued in the billions. And then gravity reasserted itself. The bubble burst, evaporating trillions in paper wealth and wiping out those who had bet their futures on the new paradigm. So, where does that indicator stand today? It is currently fluctuating around 216%. One want to repeat that. 216%. We are not just slightly overvalued. We are not even at the level of the dot-com mania. We are sitting at nearly twice the valuation seen at the peak of one of the most infamous speculative episodes in modern history. You might assume I'd be in a state of panic. You might expect me to have sold everything and be hiding in a bunker. But a lesson I learned decades ago, attributed to John Maynard Keynes, is that the market can remain irrational far longer than you can remain solvent. The question is not if the market is overvalued. That is abundantly clear. The question is why it has remained this way, and what is fueling it. Let me provide another data point that should alarm any rational observer. Examine the price-to-earnings, PE ratios of the largest, most influential companies in the S&P 500. These are the engines of the market. The average PE ratio for these dominant firms is oscillating around 66. To put that number in context. A standard, healthy PE ratio for a mature, stable business usually falls between 15 and 20. This implies that for every $1 in profit a company generates, An investor is willing to pay $15 to $20 for a share. This is reasonable. Paying $15 for $1 of earnings gives you an earnings yield of about 6.7%. It's a decent, rational return for a quality enterprise. A high-growth, tech company, one that is genuinely innovating and capturing new markets, might justifiably trade at 25 or 30 times earnings. In that case, you are paying a premium for the expectation of rapid future growth. Amazon and Google in their early days, or Apple during its explosive iPhone expansion, traded at high multiples that made sense because their earnings were compounding at 30%, 40%, or even 50% annually. But 66? This means investors are paying $66 today for a single dollar of current annual profit. It's the equivalent of paying $66 for a hamburger. You can do it, but you should have an extraordinary reason. And this is what troubles me. I cannot find the reason. Are these companies twice as innovative as they were 10 years ago? Are their growth prospects double? Are their moats, the competitive advantages I value so highly, twice as wide? A moat is the barrier that protects a business from competitors, allowing it to generate superior returns over the long term. Coca-Cola's brand is a moat. You cannot replicate its 130-year history. Visa has a network effect moat. Everyone uses it because everyone accepts it. A railroad has a physical moat. You cannot economically build a competing track. When I invest, I am looking for a durable moat. But here is the reality. Most moats do not widen over time. They are constantly under assault. Competitors, technology, and regulation all work to erode them. So when I observe companies trading at double their historical valuations, with moats that are at best stable and at worst shrinking, I am forced to ask what I am missing. The only conclusion I can draw is that participants are not buying earnings. They are buying something else. They are buying the narrative that the Federal Reserve will perpetually print money, that the dollar is destined to lose value, and that there is no alternative, TINA, to stocks. This is not investing. This is speculation on a continuation of monetary policy. Berkshire Hathaway is currently holding over $300 billion in cash and short-term treasuries. This is not because I have an affinity for cash. I do not. Cash is a guaranteed loser over the long term. Inflation ensures that it will be worth less every single day. Let me be clear about my historical dislike of holding cash. In the 1950s and 60s, I was almost constantly fully invested. I would identify a good business at a great price, buy it, and hold on. My returns were often 20%, 30%, or more. Cash was a drag. Every dollar on the sideline was an opportunity missed. But the most important lesson I learned is that sometimes the most intelligent investment is to do nothing at all. When I closed my partnership in 1969, I did so because the market had become a casino. Companies I had bought for $10 were now trading for $50, with no corresponding improvement in their business fundamentals. I returned the capital and stepped aside. People thought I was a fool, especially as the market kept rising. But after the crash of 1969, 1970, and by the time 1974 rolled around, the market was down 50%. Suddenly, I could buy incredible businesses for pennies on the dollar. I acquired the Washington Post for a fraction of its true worth. I bought assets that would compound for decades. That is the power cash gives you, optionality. When panic sets in and others are forced to sell, you are in a position to buy. That is the position I am in today. I am holding cash not because I like it, but because I find everything else to be fundamentally mispriced. When you pay 66 times earnings, you are betting on a future of flawless execution. You are assuming no new competitors, a perfect economy, and perpetually low interest rates. You are leaving yourself no margin of safety. Margin of safety is the single most vital concept in investing. You do not buy an asset for what you think it's worth. You buy it for significantly less. This provides a buffer against being wrong or against a change in circumstances. It's like building a bridge. An engineer doesn't design it to hold the exact expected weight. They design it to hold 3, 5, or 10 times that weight. That is its margin of safety. Asterisk in investing, this means buying a dollar for 50 or 60 cents. You should never pay a dollar for a dollar, and you certainly must not pay $1.50 or $2 for a dollar. At current market levels, there is no margin of safety. There is only a margin of danger. People are paying premium prices for businesses that would require a perfect future just to break even on the investment. That isn't investing. It's hoping. So, I am waiting. I am patient. I am protecting our capital so that when the market, in its eventual wisdom or panic, offers us bargains, and it always does, we will be ready to act. That is what $300 billion in cash represents. It is dry powder. It is future opportunity. Now, let's explore why this is happening, because this is where the situation becomes truly concerning. For generations, markets moved in a relatively understandable cyclical pattern. You would begin with optimism, which would lead to rising prices. This would morph into euphoria, where prices detached from any underlying value. At the peak, the smart money, the disciplined institutions would begin to quietly exit. Eventually, a catalyst would appear: a bad earnings report, a rise in interest rates, and panic would set in. The unwinding would be rapid. Prices would crash, find a bottom, and the cycle would reset, with assets once again attractively priced. That is how it always worked. But this time, we are at valuations that should have triggered this collapse years ago. Yet, it hasn't happened. Why? I see several reasons. The first reason is government spending on an unprecedented scale. The U.S. government collects approximately $5 trillion in taxes annually. That is an enormous sum. But it spends around $7 trillion. That $2 trillion difference is borrowed into existence every single year. To put this in perspective, when I began my career, the entire federal budget was measured in the low billions. Today, we borrow more than that on a monthly basis. Where does that $7 trillion go? It funds Social Security, Medicare, military contracts, and interest on the debt. What do the recipients of that money do? They spend it. They buy groceries, cars, and iPhones. And where does that spending ultimately land? It lands directly on the top line, the revenues and earnings of the very corporations that comprise the stock market. Apple's revenues swell. Amazon's packages multiply. Defense contractors' order books fill. Think of it as injecting an athlete with steroids. The athlete is indeed stronger, faster, and performing at a higher level. But that strength is artificial. The moment the steroids are withdrawn, the athlete collapses. This cannot go on forever. We are adding $2 trillion to the national debt annually. The total debt is now over $36 trillion. The interest on that debt is approaching $1 trillion per year more than we spend on defense. As the debt grows, creditors eventually demand higher interest rates, which accelerates the debt growth, creating a vicious feedback loop. But for now, as long as the government spends, corporate earnings remain artificially inflated, and stock prices remain artificially high. The second reason is the behavior of the Federal Reserve over the last 15 years. Following the 2008 crisis, the Fed unleashed quantitative easing, QE. The stated goal was to stimulate the economy and prevent deflation. But it had another, more potent effect. It massively inflated asset prices. Here is the mechanism. The Fed creates new money literally by typing numbers into a computer and uses this new money to buy bonds. In a normal economy, money is earned. It represents an exchange of value. The Fed's money is created ex nihilo out of nothing. When the Fed buys bonds on this scale, bond prices are forced up and interest rates are forced down. This has two effects. First, borrowing becomes cheap. Second, and more importantly, institutions holding bonds see their returns vanish. A 5% yield becomes a 2% yield. So what do? They are forced to seek higher returns elsewhere. They move their money into the stock market. This massive influx of capital drives stock prices up. QE, therefore, is a direct subsidy to asset prices. And who benefits? The people who own those assets. According to the Fed's own data, the top 10% of Americans own roughly 89% of all stocks. The top 1% owns about 54%. The bottom 90% owns very little. Key has been the greatest driver of wealth inequality in modern history. A massive transfer of wealth from wage earners to asset owners. The scale is staggering. In 2008, the Fed's balance sheet was about $900 billion. Today, it stands at over $7 trillion. That is trillions of dollars created from thin air and injected into the financial system. It all found a home in asset prices. If you owned assets, you became wealthy. If you didn't, you were left behind. This is not capitalism rewarding innovation. It is policy rewarding ownership. But the mechanics were even more problematic. The Fed would often announce its buying intentions in advance. The large primary dealer banks, who trade directly with the Fed, knew exactly what the Fed was going to buy. They could, and did, buy those same bonds just moments before the Fed's massive purchase orders hit the market. When the Fed's buying drove the price up, the banks would sell those bonds back to the Fed for a guaranteed risk-free profit. If you or I did that traded on advance, non-public knowledge of a massive market-moving purchase, we would be prosecuted for insider trading. When the Fed and the banks do it, it is called monetary policy. I am not alleging a crime was committed. I am saying the system itself is structured to benefit the insiders closest to the money spigot. The third reason is the most subtle: monetary inflation, or currency debasement. When the government borrows $2 trillion a year, and the Fed creates trillions more, the result is that each individual dollar becomes worth less. It's simple supply and demand. In 1970, a new car cost about $3,500. Today, it's over $40,000. Has the car become 10 times more useful? No, the dollar has become weaker. This has been accelerating since 1971, when the U.S. dollar was decoupled from gold. Before then, the government's ability to print was constrained. After 1971, the dollar became a pure fiat currency, backed by nothing but a promise. And history is undefeated. Every fiat currency in history has eventually been inflated to worthlessness. I am not suggesting the dollar will go to zero, but it will absolutely continue to lose purchasing power. If you are a sophisticated investor, and you understand this, what do? You do not hold cash, which is a melting ice cube. You buy assets, stocks, real estate, commodities, things that retain value as the currency itself depreciates. This is the key. A significant portion of what we are seeing in the stock market is not a bet on companies. It is a flight from the currency. People are buying stocks not because they are cheap, but because dollars are perceived as being in a state of terminal decline. If you own a share of Coca-Cola, you own a piece of a real business. When inflation devalues the dollar, Coca-Cola simply charges more dollars for its product. Its nominal revenues and earnings rise, and its stock price rises to match. You haven't really gained wealth, but you have protected your purchasing power from the currency's decay. This is the twisted logic that makes a P/E ratio of 66 seem plausible. People are not investing. They are hedging against the debasement of the dollar. As long as the government borrows and the Fed prints, this flight will continue, keeping asset prices disconnected from their fundamental productive value. So, you might ask, Warren, if you know this, why are you holding cash? It is a fair question. On one hand, I recognize the entire system is engineered to push asset prices higher. On the other hand, I know that systems built on unsustainable foundations always fail. They may defy gravity for years, but reality eventually reasserts itself. I lived through the stagflation of the 1970s. I lived through the 2000 crash. I lived through 2008, when the system was hours from oblivion. Every time, the experts said, this time is different. Every time, they were wrong. I would rather miss out on the final innings of a rally than risk a permanent loss of capital. Rule number 1, don't lose money. Rule number 2, don't forget rule #1. Another deep concern is the structure of the market itself. It is no longer a transparent venue for price discovery. Today, roughly 50% of all trades occur in dark pools. These are private exchanges, run by large banks, where trades are executed in complete secrecy. The public market, where you and I trade, only sees half the activity. This is not a level playing field. Add to this high-frequency trading, HFT, algorithms. These are machines that execute trades in microseconds, detecting an order from an ordinary investor and front-running it, buying the stock a fraction of a second before you, only to sell it back to you at a minuscule profit. This is a tax on every single investor, paid to those with the fastest computers. The market today is faster, but it is also more opaque and more tilted toward insiders. It is a rigged game. I am not suggesting a conspiracy. I am saying the incentives of the system have shaped it this way. And the result of this system is the most dangerous part of all, the social consequences. The levels of wealth inequality we are seeing are not just economically problematic. They are politically and socially destabilizing. When the top 10% owns 70% of all wealth, and the bottom 50% owns virtually nothing, you do not have a stable society. You have a powder keg. In 1989, the bottom 50% of Americans owned 3.6% of the wealth. Today, they own 2.5%. In 1965, the average CEO made 20 times the average worker. Today, it is 350 times. I have been a primary beneficiary of this system. But I recognize I won the ovarian lottery, born in the right country at the right time. The idea that all wealth is merited and all poverty is deserved is not just false. It is dangerous. When people feel the system is rigged, their anger breeds instability. We are at 1920s levels of inequality, and that era was followed by the Great Depression and profound political upheaval. This isn't about envy. It's about economic efficiency. A wealthy few save their money. A thriving middle class spends it, creating the demand that fuels the entire economy. So, the question everyone asks, when will it crash? The honest answer is I do not know. Nobody does. Markets crash when something breaks. Right now, the system is being held together by the glue of government spending and Fed intervention. But the pressure is building. What could the trigger be? An inflation spiral. If inflation reignites, the Fed may be forced to raise rates dramatically. As Paul Volcker did in 1980, that would be poison for these asset prices. A foreign creditor. Crisis. The U.S. relies on other nations, like China and the BRICS, to buy our $2 trillion in new debt each year. What if they stop? A social breakdown. The inequality I mentioned could boil over into political and social unrest that markets cannot ignore. Banking crisis. Silicon Valley. Banks' failure in 2023 was a symptom. U.S. banks are still sitting on over $500 billion. in unrealized losses from bonds that have lost value. If another bank run forces them to sell, those losses become real and could cascade. Simple mathematics. The current path is not sustainable. You cannot borrow and print your way to prosperity forever. The bill always comes due. The bigger the bubble, the more violent the pop. We are in the complacency and excess phase. The crisis will come. What should you do? If you are young, you can afford the volatility. Use dollar cost averaging into diversified funds. Do not try to time the market. Your friend is time. If you are middle-aged, you must balance risk. You have less time to recover. Be honest about your true tolerance for pain. If a 40% drop would cause you to panic sell, you are taking too much risk right now. If you are retired, you are in the most dangerous position. Capital preservation is your only goal. It is frustrating to hold cash, but you cannot afford a 50% loss from which you will never recover. My advice for everyone is timeless. Don't invest in things you don't understand. Diversify, minimize costs, and control your emotions. The market is a device for transferring money from the impatient to the patient. Do not let the market dictate your life. Focus on what you can control, your savings, your behavior. The market we have today is more of a casino than a mechanism for capital allocation. I still believe in America, but we must be clear-eyed about the dangers. People always say, this time is different. They are always wrong. Gravity always reasserts itself. My job is to be positioned for that return to reality. It means being patient. It means being willing to look foolish, sitting on cash while others celebrate. It means knowing that being early is better than being catastrophically wrong. Protect the downside, and the upside will take care of itself. Be careful. Be patient. And remember that the fundamentals always matter in the end. Thank you.